Whether interest rates are in the 3s or the 6s, the fixed rate mortgage is one of the most powerful wealth builders in the universe. Number one is appreciation. And it's not just appreciation, but it's leveraged appreciation. So for example, if you put 20% down on a home, you are leveraged 5x. And so what that means is if you get 5% appreciation, you actually don't have 5% appreciation on your money. You multiply that by the 5x factor, which would be a 25% return. Another example is if you're 10% down, that is 10x leverage. And so 5% down then turns into a 50% return on your investment. That's amazing thing with a fixed rate mortgage is that the bank is paying for a majority of the capital, yet they're not benefiting from any of the appreciation. What other business endeavor is out there that allows you to take advantage of 100% when you're not putting down all of the money? The second key is this principal savings account. So when you make a mortgage payment, a portion of that payment goes towards principal. You're paying down that loan. So if you have a 15-year loan, it pays off in 15 years. If you have a 30-year loan, it pays off in 30 years. So a portion of that payment goes to kind of like a forced savings account that you get to benefit from later when either you sell the home or you refinance the home. The third benefit is tax savings. And so check with your CPA, check with your accountant. Everybody's taxes are different, but in general, you're able to deduct a portion of your mortgage payment towards your taxes. So oftentimes it's your interest and the taxes that you are paid. And so that can lower your tax bracket. That will also likely decrease the amount of taxes paid and give you a refund. You can even file what's called a W-4 to lower the amount of taxes that you pay each month to factor this in to increase your cash flow each month. And the reason that Uncle Sam does this is they want to partner with you on your mortgage. Why are they doing that? And the reason for that is because of our debt in this country. They can only increase their debt load when you take out a mortgage. And so the government is actually incentivizing you to take out this mortgage because they have debt and they need your debt to be able to finance their government spending, their over government spending that they're doing. So let's go over a quick example of a $300,000 home versus renting. Quick disclaimer, there's a lot of assumptions baked into this example. Your situation may be different, but this example will help you start to understand the concepts and how this can apply to your situation. So number one, $300,000 home, let's assume that mortgage payment is $1,850 a month, and to rent that same home is $1,750 per month. I would argue that you probably can't get apples for apples because typically buying a home is going to be more well maintained than renting a home. But let's say you could do the same thing, renting versus buying, $1,850 versus $1,750. On the surface, it looks cheaper to rent, but when we apply these three principles, we'll see that it's different. So number one, let's look at that appreciation. So historical appreciation rates are between 3 and 5%. So let's take somewhere in the middle at 4%. So on a $300,000 home, 4% appreciation is an annualized appreciation of $12,000 per year. If you divide that by 12 months in a year, you get an average of $1,000 of appreciation each and every month. And so if your mortgage payment was $1,850, you subtract the $1,000 appreciation that you're going to be able to benefit from in the future when you sell your home or you refinance, that takes your net down to $850 at this point. All right, so number two is your principal reduction. As we mentioned, a portion of your mortgage goes towards principal reduction. It starts out small and grows over time, especially towards the end of your 15 or 30-year mortgage. So in this example, let's assume that $250 of that payment is going towards principal reduction. So again, starting our example, $1,850 mortgage, $1,000 off of that for appreciation, we get to $850, another $250 off for your principal reduction. Now we're down to $600 for your net investment on this home. So that third principle is your tax estimated savings. So a lot of assumptions go into this depending on what your national, your federal tax rate is, your Alabama state tax rate is. But assuming, I believe we assumed 24% on those numbers, we're gonna get about a $480 per month tax savings. And so there's two ways to benefit from this. You can benefit from a tax refund at the end of the year, or you can refile your W-4 so that you claim more dependents and keep more of your take-home pay each and every month to increase your cash flow. So this one is different than the first two. The first two are appreciation and your principal reduction. Those are benefits that you're going to get as you sell your home or as you refinance. Your taxes are going to be something that you benefit from when you collect your refund check or as you lower your taxes on a monthly basis. So with that estimated $480 savings, we're now down to $120 per month in your net investment in this home versus $1,750 a month in renting. So not only are you at $1,750 versus $120 a month in your mortgage payment and your net savings, but as you assume appreciation on that rental value over time, if you look at a 3% appreciation rate, which is probably pretty conservative for rental appreciation, in 10 years, that's going to add up to $2,283. So you've got a $2,283 payment versus a net payment, a net investment payment of about $120 on your mortgage. So with rent of about $1,750 per month and potentially increasing to about $2,283 per month over the next 10 years, and you contrast that to your net investment payment on your mortgage of only about $120 per month, is there any doubt on why there's a net worth difference between homeowners and renters? It's about 40x difference, about $5,500 versus over $250,000 for homeowners. So if you'd like to become a homeowner this year and increase your net worth, send us an email at moving@mattcurtisrealestate.com. That's moving@mattcurtisrealestate.com, and we look forward to helping you achieve your real estate dreams this year.